for leasing is similar. Okay, so usually a lease agreement will define the periodic lease payments and the lease term and when the payments was made. So since the lease payment was $10,000 every year for 25 years, and also the lease payment was made at the beginning of each year, it also implied this lease is an annuity deal. And 25 interest was given 10%. So we just look up the table, present value of annuity deal. We can find the present value factor was 9.98474. We just multiply the periodic lease payments, so this will represent present value of these lease payments. And also for financial reporting, it represents the book value of the leased assets and lease liability. So the valuation of these assets is determined by the future cash flows. Same for the lease liabilities. From this journal entry, we can learn the leasing is no different from the debt financing, right? So the company recorded assets while a liability. But this procedure or this number was calculated using the present value of future cash flows. This is an operating lease. Provide a off-balance sheet financing. The reason is there is no explicit contract between the lessee and the lessor. And this number was just calculated based on the lease agreement and lease payments. If we don't do this calculation, this leased assets or lease liability will not be reported in the balance sheet. To report this ROU assets or lease liability, we basically need these procedures to report these assets and liability on the balance sheet. This is also based on the new accounting standards. The companies should report their operating lease as ROU assets in the balance sheet. This example is also very simple. And it's a lease payment, $16,000 each May 31st. 6 payments, interest 6%. Since the first payment was made just on the first day, so it implies this lease payment is an annuity deal. To calculate the present value or initial value, we just use lease payments, multiply the present value of annuity due, 6 years, 6%.